Thibaut, what are the main lessons for you from 2020?
On the office market, although prime yields have managed to remain flat in offices, capital values have peaked after 5 consecutive years of rapid growth, about 8.5% per annum on average in Europe. And they have even started to decline in several locations, Eastern Europe, Nordics, Spain, as well as in the UK since the Brexit. As well, investment in offices have fallen by 34% in 2020, which is more than the real estate average of minus 26%, which is showing increasing uncertainties about the fundamentals of the office market.
Is remote working a risk for office valuations?
Indeed, COVID-19 has been a game changer in the way people work. Mobility to workplaces has dropped by 30 to 40% across most European cities on the back of increasing remote working practices and sanitary measures. According to a recent ILO study, which is showed on the slide 1, the potential for remote working stands between 25 and 30% for most European countries, which is significantly higher than pre-COVID, and particularly in Spain and in Italy. Hybrid remote working will be preferred to full remote working for a couple of reasons. One is optimal productivity per employee. 2 is fuel personal connections. 3, avoid social isolation. And 4, safeguard the corporate culture and training, notably for the new joiners. Moreover, increasing wellness and sanitary measures in offices will partially counterbalance the impact of remote working in the vacant spaces. All in all, our case study on the Paris Île-de-France market estimates the increase in vacancy spaces due to remote working of around 1.7 million square meters in 5-year time, and the total net impact on vacancy rate would be 1.8% increase by 2030.
Where do we see the value now?
So we expect a 5 to 10% decline in the capital value of offices across Europe in the coming years, with Germany and Italy being more resilient, while France and Spain will be affected by 2 specific factors. Paris negatively impacted in the short term by high expected deliveries in 2022 and 23, and Spain by a higher dependency on cross-border inflows. However, we believe that the demand for offices will remain supported in the medium term, given the low yield environment and the relatively high pickup in cap rate offered by offices, as well as strong pension dynamics. On a relative value basis, our analysis tends to show that Lille, Marseille, Berlin, Hamburg, Lisbon, and some Nordic cities such as Stockholm and Oslo offer some good value for offices and attractive relative value versus other asset classes in the same locations. Finally, over the next 12 months, we believe that hub and spoke strategies are likely to develop. Inner rim prime locations close to transportation hub could be sought after to reduce cost. And for very large companies, a combination of main headquarters in central districts coupled with smaller satellite offices in secondary locations or in regional head offices is also very likely to take place. So, Alexis, how does the COVID crisis change a lender's appetite for office?
First, we have to notice that office is the first asset class financed by the lenders, offers a very large and liquid market, and has not been immediately affected by the crisis, because most of the tenants continue to pay their rents and capital values are not decreased yet, so office remains for the lenders a very important market. Of course, due to the combined effect of remote working and difficult economic environment, lenders are very careful about the risk of a progressive decrease of rental and capital values in the coming years. Moreover, we pay more attention to the location and specific characteristics of the buildings that need to be adapted to the future tenant need in terms of sanitary constraints, but also in terms of flexibility and services to attract companies.
Are lenders still ready to finance new office development with letting risks?
In 2020, the value of the prime assets didn't decrease, but we noticed an increase in risk premium asked by the buyers for the new development due to more uncertainty of future rental value, which leads to a lower debt per square meter for lenders. Moreover, even if the letting risk made lenders very cautious about the project they studies, brand new buildings that will benefit from good location and fit perfectly to the future tenant needs are still attracting lenders' appetite, especially for green loans, which is a growing number of investors are coming to. For this type of project, lenders are also very focused on clients which benefit from the strong asset management track record and the long-term relationship.
Finally, Alexis, what are the main changes in terms of financing conditions?
In terms of leverage, anticipating an adjustment in rental and capital values, LTV decreased by 5 to 10%, from 60 to 65 to 50 to 55. About the pricing, after a sharp increase in mid-2020 of around 50 to 75 basis points, following this increase in the bank's liquidity cost, margin came back to their pre-COVID level, except for the projects with a significant letting risk for which there is still a 50 basis points premium compared to pre-COVID margins. Longer maturity for assets with firm lease are also reduced from 10 to 7 to 8 years, taking into account more buffer for lease renegotiation, but also Basel III revised constraints that penalize lenders on longer terms.